Good morning, everybody, and welcome to the latest segment in RSM Australia's Business Essentials series. This series looks at different contemporary issues for business owners. Our previous topics have included tax planning for end of financial year, as well as sessions on cybersecurity. And today's session will include a market update from RSM Australia's Economist, Devika. First of all, we'd like to acknowledge the traditional owners of the lands and the waterways on which we gather today, wherever we're coming from, and pay our respects to elders past, present, and emerging. A little bit about Devika, our presenter. As our expert economist, Devika loves to share her knowledge with our clients. She has a wealth of experience in macroeconomic and financial research, spanning both public and private sectors, as well as a deep understanding of the APAC region. I would like to hand over to Devika to commence her presentation from here.
Good morning, everyone, and thank you so much for making the time to attend the session today. I look forward to an engaging discussion, and I'm keen to learn as much from small business owners who have joined today as much as I'm happy to share my insights from a data point of view. Of course, it's going to be a brief presentation followed by a question and answer session. So let's get started. There are four key topics that I will be touching upon. Of course, number one is the global economic developments. We move on to the domestic economic developments, which are more relevant for small Australian businesses. The impact the domestic economic developments are having on this particular sector, followed by what are the opportunities for the small businesses looking at the current macroeconomic dynamics. There's no surprise here. Basically, the talk of the town has been what's happening in the Middle East, what's happening in Russia and Ukraine, and what's going to happen in the USA. The Russia-Ukraine war has unfortunately been going on for a while now. And while the risks of it spilling into the broader region looks less and less diminished until and unless the war actually comes to a proper finish, we are going to see a lot of fluctuations, particularly in the energy market. There is a potential for some supply chain disruptions at the global level, as well as there are going to be some significant geopolitical realignments depending on which country aligns with which side. That is always a risk when two countries go to war with each other, and this could be termed as what we consider collateral damage. The Israel-Hamas war, unfortunately, is something that has only started recently, but the risk is a lot bigger here because the participants are in a much more condensed region of some key oil-producing countries. The biggest risk from the Israel-Hamas war obviously comes to regional instability as well as petrol prices. If most of the oil OPEC countries in the region decide to get involved in the war, there's a risk that not only would the supply of fuel be impacted, that would also mean prices of fuel, which are already very fluctuating, would tend to go higher, which means domestically, we are going to see that reflected on the bowser and impact our day-to-day expenses. Economic strain obviously is another key consideration, regardless of whether the war is happening in Russia and Ukraine or in the Middle East or anywhere in the world for that matter, because of the increased humanitarian and reconstruction costs, which obviously tend to impact global priorities, because most often than not, it is the other global players, particularly the developed nations, who tend to send in financial aid to their allies. The US elections is the next big thing. Of course, we are aware that Trump and Biden were the two contenders initially. Mr. Biden has since dropped, and Kamala Harris is the new contender now. Of course, the scales seem a bit more finely balanced now, considering Mr. Biden has decided to step down after what could be termed as a one-sided debate earlier this year. The contest is finely balanced. The elections are set to take place on 2nd November, and we should have some clarity on who is the next US president towards the end of the year. Of course, what this means is we need to understand what each of the candidate is presenting as their priorities when they come to power, what we call the election manifesto. Neither of the two candidates have actually published a detailed manifesto as of now, but we are aware that the biggest risk could potentially come from the trade channel because the US is number one, predominantly a very, very powerful country on the global trade front, one of the leading trade partners for Australia in the broader APAC region as well as in the European region. And of course, from the currency point of view, because the Australian dollar is pegged to the US dollar. So if consumer confidence or the market confidence in the US economy remains sustained and the US dollar remains strong, we can expect some more action domestically from the central bank to make sure that the Aussie does not depreciate too much. But if the confidence in the US dollar falls, we can expect the Aussie dollar to appreciate a lot, which impacts the external sector, which is the trade balance dynamics significantly, which on a broader level flows into the government's budget surplus or deficit. Market volatility obviously typically causes market fluctuations, and policy shifts are quite critical, whether at a global stage or at a national stage. What are the domestic economic developments? I think we are all aware of what has been happening in Australia over the last couple of years, but I'm happy to break it down into more simpler language to really understand what it is that the RBA is looking at, what it is that the government is looking at, and how do the fiscal and the monetary policies actually come together, and what is the impact that small, medium, or large businesses tend to have when any kind of a decision is made by any side of the policy making bodies. Let's look at growth first, which is quite critical. The first quarter of 2024 registered a growth of 0.1% quarter on quarter, which is almost flat, and a modest 1.1% annual growth. There's still expectations of a soft landing, which means we are not going to have a recession, but unfortunately, we are already in a per capita recession. It's important to look at this from a context of migration because per capita recession is essentially the growth revenue, which is GDP in Aussie billion dollars divided by the number of people in Australia. So obviously, when the denominator increases, your share obviously is going to become smaller and smaller. So even though overall, as a nation, we are doing really well, we have survived a recession, we are not going, we have beaten a recession, we potentially are not going to go into one. Individual standard of living seems to have taken a significant hit because currently we're sitting at the fifth consecutive quarter of per capita recession, which is quite significant. What has so far supported growth? We've seen that during the pandemic, because of the forced lockdowns, there was an excess buffer of savings over 2 years. There was a time when household savings ratios reached as high as 25%, a historical high, when our national average over the last 10 to 15 years has been a simple 5%. Just imagine the distance, the difference between an average of 5% and a historical high of 25% soon after we had come out of the pandemic. Of course, when there was forced lockdown, what happened was there was a significant shift in the psyche of consumers. Everyone thought, what if we had another pandemic? What if we were not able to enjoy as much as, what if not to take our freedom for granted? What if we are not able to go out about, meet our near and dear ones, go out for dinners, lunches, movies, trips, if another pandemic hits again? That drove most of the consumers to spend excessively as soon as the lockdowns were lifted. Now, the tricky thing was Australia was fairly insulated in the pandemic. If we compare the Australian position to the rest of the world, whether it's in Asia or globally, our death numbers were significantly lower. We still had the ability to move within the state, within our LGAs. Of course, it was a lot stricter just when the pandemic had started, but we had it fairly easy. Of course, what that meant was Australia did open its borders. Australia did lift its restrictions domestically. and internationally to some extent with heavy scrutiny, the rest of the world had not opened as fast as Australia had because their situation had not improved or their situation was never as good as Australia had its own situation. What that meant was most of our key trade partners were still under a lockdown. So while the Australian consumer was out about and demanding goods and services, the supply side of the equation was still cut off. The supply side was still shut down. Now, Economics 101 tells us that when demand outpaces supply, we have the problem of inflation. Add to the mix, the jobs market was extremely strong just after the pandemic. Unfortunately, a lot of people flew out of Australia because there were some expats who thought in this difficult time it was important to be close to the family. There were some expats who had to unfortunately go back because they lost friends and family. Once they left the Australian shores, it was harder to come back in because of the strict border regulations, which meant that the labor market was particularly tight. Now, when the labor market is tight, obviously the jobs market is really, really strong and everyone has a steady income. So, put all this in perspective, our growth number was essentially extremely strong, and we are still, in fact, benefiting from the strength of what we saw post pandemic, which is what has still kept us out of a recession. Although growth has been moderating, the government has come up with some excellent policies to support local businesses, support consumers, households in this fight against inflation and higher costs of living. If we move to inflation, inflation peaked at 7.8% in December 2022, which was quite a while ago. We are nearing the 2-year mark since we saw the peak of 7.8% year on year. And currently, as of second quarter 2024, we are sitting at 3.8%. We have more than halved inflation since the peak. Trimmed mean inflation, which strips out all the volatility and is predominantly focused in the services sector, is sitting at 3.9% year on year, which is marginally higher than the 3.8% mark. Goods prices obviously are easing a lot faster than services, primarily because of the point we discussed earlier. The supply side has completely resolved itself. So a lot of goods, the flow of goods to and fro from the country has completely normalized. So it's easier to find goods, even if you were to say perhaps import them. Services, on the other hand, I think is very closely linked to the labor market. I'll touch upon that in a bit. Inflation, the RBA's target to get inflation down is 2.5%. It's the midpoint of 2% to 3%. Even if inflation is to touch the upper end of the 3%, at the 2 to 3% band, I think the RBA might be slightly relaxed that, okay, inflation is moving in the right direction. But as things stand today, we are currently sitting at 3.8% for headline and 3.9% for trimmed mean, which means we are still quite far away from the RBA's target. We are getting there, but we are getting there really, really slowly. That brings us to the point, why? Why is it that inflation is falling so slowly? Let me take you back to the point I said that goods prices are easing faster than services, and services are linked closely to the labor market. Now, why is that? Services sector obviously employs the bulk of Australian citizens in the jobs market, whether it is hospitality, whether it is childcare, education, professional services, insurance services, you name it, you have it. The services sector is key for employing most of the Australians. If we think back to what happened in the pandemic with a significant outflow of people, there was some substantial there was a substantial lack of the number of there was substantial lack in applicants for each job vacancy. Businesses initially were finding it really hard to find applicants for each job ad they were posting. If 2 years ago a company produced 5 job ads, it would probably have around, say, 10 applicants, an average of, say, 2 applicants per job, which meant that the labor market was extremely tight. As of today, we have moved on from the absolute tightness in the labor market to the structural side of things, which means now businesses are not struggling to find people, but businesses are struggling to find the right skill set yielding people. To put it simply, if one job advertisement gave you two job applicants 3 years ago, which was the problem of absolutely tight labor market, a structurally tight labor market, which is the scene today, would probably give you five applicants per job ad, but none of them would be the best fit. Now, that's a particularly big challenge for small businesses where they have to contend with a smaller pool of candidates with lesser options, perhaps because they are centered in the regional areas. If not, even if they are in the capital city areas, they are competing with bigger firms who are able to pay higher wages. So the problem really is not moving. The labor market continues to remain tight. Unemployment rate currently at 4.2% is still at a multi-decade low. Ideally, the RBA would like to see unemployment touch the 4.3 to 4.4% mark, but the series is extremely volatile. Over the last 2 months, what we saw was there was a significant jump in part-time employments versus full-time employments, which makes us think perhaps it's not just it's perhaps the second eligible member in a household entering the jobs market to support the house in the face of higher interest rates and higher inflation problem. That really doesn't solve the problem of structural employment, because even if people are going into part-time jobs, they are usually jobs which are centered in um, typically low to medium skilled jobs, nothing niche, where the structural unemployment problem still persists. Now, when there's a tight labor market, what does it mean for wages? Obviously, if businesses are finding it hard to find the right labor, they would be willing to pay top dollar to keep the candidate, whether it is someone you already have at your firm where you would like to keep them with yourself, or if you are looking for other good candidates outside, you are aware that there's a lot of competition and the bargaining power is with the employees. They do have the power to bargain higher wages. What does that mean for small businesses? It means wage pressures, cost pressures, squeezed profit margins. The challenge currently that Australia faces is not that wages are high and sitting at above the 4% mark, whereas inflation is around the 3.8 to 3.9% mark. The problem is productivity has not been delivering as much as wages have been growing. Unfortunately, wages are growing at a rate of an average of 4%, whereas productivity is growing at an average of about 1% over the last 3 to 4 years. That's a significant loss for businesses, whether you're a small business, medium sized business, or a large business. Unless and until productivity improves, there's less likelihood that you would see an improvement in your conditions. What is productivity? Basically, the amount you're paying, to put it simply, the amount you're paying to your employees, they are able to produce work to generate revenue to match the investment you are doing into that particular candidate. That obviously doesn't seem to be matching, which brings us to the problem of inflation again. Each labor that a business is hiring becomes an additional labor cost. Inflation is a mix of labor as well as non-labor costs. Labor costs are predominantly centered in the services sector, whereas non-labor costs are predominantly centered in the goods sector of the economy. As of today, we are seeing a slight shift, a slight turn in the labor market. We are seeing that unemployment rate is inching up, but at the same time, employment growth is also inching up, which means there is still some spare capacity in the market where new people are still being absorbed into jobs even today. Despite all the pressures that businesses are feeling, they are still looking for ideal candidates to fill vacancies within their companies. This brings us to the next question. If this is what is happening, what is the RBA doing? What is the RBA thinking? And when are we going to have the first cut? I think this is a discussion which is common across, whether you are sitting with your friends, whether you're sitting with your spouse, with your kids, with your colleagues, in a pub or in a cafe. Everyone just has one question on their mind. When is the RBA going to cut? I'd like to draw your attention to the chart here. It's a very interesting chart. The red line is the RBA, the blue one is the US Federal Reserve, green is Bank of England, RBNZ is dark gray, the light gray represents the European Central Bank, and the black is the Bank of Canada. If you see, the red line has been sitting way below its global peers. It's only now, after the European Central Bank has had its first rate cut, that it's gone below the RBA. But we have consistently been below our global peers, sitting at 4.35% for quite a while now. Rest of the central banks around the developed world have hiked and reached almost as high as 5%. The US Fed is at 5.5%. The Bank of Canada has had two cuts and they are expecting a bit more. Bank of England has had its first cut and it is likely to start cutting a bit more towards as we move ahead. But the common thing between all these countries and something which distinguishes Australia is number one, Australia has not seen a recession. England has, Canada has. US, Canada, Europe, England, all of them have had their inflation touch their target range. Australia has not. Therefore, it is important that the RBA stays on hold for a bit longer to make sure our inflation comes down faster. Now, it makes you wonder, if that was the case, if the RBA needs to stay higher for longer, why not hike quickly and then start cutting just like the rest of the world did? But there's another key difference between Australia and the rest of the market. That is the difference between the tenure of a fixed mortgage in Australia versus a fixed mortgage elsewhere. Take the example of the US. US has 30-year fixed mortgage period, which means every time the US Federal Reserve increases interest rates, it really does not impact mortgage home borrowers as much as it would an ordinary Australian, because we tend to have a fixed rate of, say, an average of 2 to 3 years, whereas most of it is variable. The policy transmission channel is so fluid and so quick in Australia that the RBA really cannot afford to go so high. The RBA has also prioritized a soft landing, which means not going into a recession. If you look at all the communication coming out from the RBA, they have been quite specific about not having a recession, being a bit patient with inflation coming down, even if it means they have to stay higher for longer, and at the same time making sure that mortgage borrowers are able to service their debt obligations. Of course, at 4.35%, existing borrowers who have changed from a fixed rate of, say, 1% to 2% and suddenly seen their mortgage payments go up to 7% because of the change, once they switched from fixed to variable, they're still finding it difficult. But the RBA has taken note of that and is making sure that the pain does not extend beyond a certain point in time, which is why it's very, very important that inflation comes down under control soon enough, which means the RBA needs to stay higher for longer. So far, we've seen the communication from the RBA governor saying that they do not expect to cut in the next 6 months, but it's important to understand that everything is highly data dependent. If data moves in a favorable direction, which means inflation starts coming down a lot faster, I'm pretty sure the RBA would reconsider its position. But as of the data today, the RBA governor is right to say that it's still too soon to consider rate cuts. Now, what are the risks? Our base case has been for a while that the first cut comes in November 2024, followed by extended hold until 2Q25. This has been our case since the beginning of the year. But again, a point that I stressed earlier, everything is highly, highly data dependent. Now, what are the risks to this outlook? What are the domestic risks? Domestic risk is that demand is a lot weaker than expected. Consumers completely stop their spending, which we have already been seeing. Consumers have significantly scaled back their discretionary spending, and they are only focusing on the essential expenditure for houses. There's a faster decline in inflation. Good news, if there's a faster decline in inflation, RBA will be able to start cutting a lot sooner than what it is currently saying. The upside risk is inflation takes longer to return to target than anticipated, which unfortunately is the situation today, which means the RBA will be forced to stay higher for longer. And our call for a November cut is obviously not something we can expect to materialize. Inflation expectations could drift upwards. What are inflation expectations? In a high inflationary environment, what tends to happen is if people get used to this higher cost environment, they might start negotiating higher wages simply because they say, okay, inflation is sitting here, it's not coming down, this is the new norm, we have to get used to it, we want our wages to match inflation now. What that means is there is more pressure on businesses to provide higher wages, but that also in turn means those costs get passed back on to the consumers because businesses also have to maintain their margins in order to survive. So it becomes a vicious price wage spiral where it is extremely important that inflation expectations remain anchored, they remain contained. We cannot let inflation expectations increase. So it's important for the RBA to make sure people are confident in its capability to bring to bring inflation down, which is why it means the risk to our call that the RBA is going to stay higher for longer is quite significant. Like I mentioned, labor costs move upwards, and structural unemployment obviously results in sustained wage pressures. If there's a dearth of candidates with the right skill sets, businesses will be competing with each other by offering top dollar to the right candidate. On the international front, what's happening? The China weakness. I think this is particularly important to understand from an Australian perspective because China is our largest trading partner. We are already aware that the real estate market in China is significantly weak despite a lot of fiscal injection. By fiscal injection, we mean government subsidies into this to put into the sector to revive it, but there hasn't been significant improvement per se. Why does that bother Australia? That bothers Australia because the real estate sector in China is what drives the demand for core commodities in Australia, whether it is iron ore, coal, steel, you name it, most of the commodities that go out from Australia are predominantly channeled into the real estate sector in China. Broadly for a commodity basket, the picture may not be that bleak because on the Chinese front, even though there has been a significant weakness in the real estate market, they have now started moving towards what was traditionally their stronghold, which is the manufacturing sector. And particularly in the manufacturing sector, they're focused on the new energy vehicle space. What do new energy vehicles mean? It means EVs. And what do EVs need? What do they run on? They run on batteries. And what does batteries? What constitutes a car battery? Lithium. Again, Australia is one of the leading producers of lithium. So broadly, the increase in demand for lithium may somewhat offset the fall in the demand for iron ore, core, and steel. But it's only a matter of time before the scales get tipped and it impacts our commodities basket negatively. That means obviously our commodity prices will get impacted, which by extension means our Australian dollar gets impacted. Then again, I bring us back to the first point I mentioned. When the currency gets hit from the external trade point of view, it directly impacts the government's budget position. Geopolitical tensions, something we touched upon earlier as well. High tradable inflation risk, which is out of RBA's control. It's an upside risk. I would suggest everyone go back and read a lot of the new communication that has been coming out from the RBA governor. There's a particular distinction in inflation that has been a common feature in most of the speeches, which is the difference between tradable inflation and non-tradable inflation. Currently, the RBA's focus is on non-tradable inflation, which means inflation that cannot be traded, which means domestically driven inflation, which means inflation driven by you and me who are living in Australia. Tradable inflation is something that comes from outside of Australia, which is a result of trade dynamics. Obviously, tradables inflation is a result of geopolitical tensions, trade uncertainties, supply chain disruptions, and whatnot, all the points that we discussed earlier. Now, geopolitical tensions gave a rise to this tradable inflation side of things, which as of now have significantly come under control. A lot of the supply chain side has normalized, which means tradable inflation has been falling a lot faster than non-tradable side of things. But should the geopolitical tensions continue to outpace or continue to be extended, continue to play on for a longer time, it is definitely going to impact not only the supply chain but the energy market and anything and everything that Australia potentially is vulnerable to. The topmost everyday expense, whether you're a business or a consumer, is obviously fuel costs. It almost feeds into your weekly budget. And of course, if the global supply chain gets disrupted, we know what happened just after the pandemic. The example I told you about, Australia had opened its borders, but the rest of the world had not. What did that mean? Goods and services were not able to reach Australia. So, if geopolitical tensions were to cross its borders and extend into the broader regions, impacting supply chain, we could unfortunately be pushed back into that era of high tradable inflation. That is a risk that RBA is mindful of, and that's the best it can do. Unfortunately, that is something the central bank cannot control with its policies. So as of now, the current position, the RBA is unlikely to cut interest rates anytime soon. We should expect the interest rates to sit at 4.35%, at least until the end of the year, is what the governor has said. But again, that has to be taken in the context of the data that gets released up until the end of the year. If inflation continues to fall rightly in the right direction at the right pace, I'm pretty sure the RBA would be willing to reconsider its position. Now, what are the impacts on small businesses from all these macroeconomic dynamics? Number one, reduced consumer spending. Retail sales data of late has pointed that it has been very, very volatile. Most of the consumers are being very smart with how they're spending their money now. They tend to choose or do heavy shopping or big ticket purchases only during sale periods. We've seen a lot of the sale periods being extended, whether it is the EO5 sale, whether it is the Black Friday sale, whether it is the holiday season sale, the Christmas sale. It's most of the retail spending happens only during the sale periods. Otherwise, consumers are not willing to really spend money too much. What does that mean for a small business is small businesses are perhaps not able to offer sales or sale periods as much as big, you know, retail chains can. Obviously, there's a lot of things at play here when we compare small businesses to, say, big retail chains. Number one, the economies of scale. Small businesses are, as it's in their name, smaller. So their outreach is smaller, their client base is smaller, and their capabilities are significantly smaller than large retail chains, where they are able to perhaps diversify their risks by shifting products from one store to the other, from one region to the other, depending on where demand is coming from. That unfortunately is not something that is potentially an option for small businesses, particularly if they are centered in one region only. So low growth, subdued consumption obviously leads to decreased sales and revenue for small businesses. Higher operating costs. If you are sourcing goods and materials from other vendors, there's a very good chance that they have jacked up their prices. So obviously that means in an inflationary environment, it is extremely hard to source goods and raw materials for your own business at a reasonable cost, which means your day-to-day costs have shot up, your profit margins are not increasing, and because of reduced consumer spending, you're not really meeting your revenue goals. Not only that, small businesses also have to contend with higher utilities cost. Electricity costs have been significantly higher. For A young couple with young kids, there is a chance that they have to leave the kid in a childcare center while they run their businesses. But childcare costs, we are all aware, are running amok. Um, there are a lot of challenges, not just utilities, goods, services, but everything feeds. When you look at the broader picture, the inflation is actually the real villain, because it's not that businesses or vendors are jacking up prices for profiteering. No, it could just be a means of survival. It could just be the only way they are able to extend their timeline without having to exit the market altogether, just simply because their business has gone down. Labor market pressures, a point we have discussed at length today. Of course, a tight labor market will drive up wages, will make it harder for small businesses to retain and hire talent. Increased borrowing costs is a byproduct of higher interest rates. Now, why are small businesses particularly susceptible to higher interest rates and not big businesses? The logic is simple. Most of the time, the reliance of small businesses on external funding is a lot greater than the reliance of big businesses on external funding. Big businesses have an operating model. Big businesses are able to plow back their profits from their revenues back into, say, investment opportunities, growth opportunities, expansion, you name it. They are able to probably um, channel their profits into those new areas that they're looking to explore, whereas that is not an experience small businesses tend to have, simply because they rely on external borrowing. Now, external borrowing gets a lot harder when interest rates are really high, particularly as a borrower. If you do go to the bank and say, hey guys, I'm looking for some more funding, the first thing the bank is going to ask you is, are you able to service your debt obligations? If you're not, unfortunately, you're not able to tap into the financial resources that you need, which means you are limiting your expansion opportunities. Not only that, very similar to what we are seeing with home borrowers, where potential new first home borrowers are not able to enter the market. That's a similar situation for small businesses as well. Whether you're a new business or whether you're an existing business looking to venture into a new area, getting external financing is going to be extremely expensive. Cash flow strain affecting day-to-day operations. If you have employed people on daily wages, but you're not generating enough revenue throughout the day to service those wage obligations, if you're not able to generate enough revenue to service your debt obligations towards your vendors, obviously it is going to impact your day-to-day operations. There's a risk people might leave because obviously they are also in need of wages. There's a risk vendors might say, I'm sorry, we cannot continue this relationship simply because you're not able to service your debt. And then that means obviously your overall business is not really doing very well. Supply chain disruptions again impacts sourcing goods, services, raw materials. Global uncertainties obviously lead to a lot of delays, and that's the last thing you need really when you're already grappling with reduced consumer spending, operating costs, high interest environment. The last thing you really need is a supply chain disruption, something that is completely beyond your control. And risk of insolvency, of course, this is the ultimate result for small businesses once they are grappling with all these issues that we have discussed previously. Prolonged economic challenges can only mean one thing. There's only so many times small business operators can tap into their personal wealth to keep the business running. There's only so much time that a small business can actually extend its lifeline, say by a couple of months, because once external funding becomes difficult, your personal wealth dries up, you're not able to meet your debt obligation. It increases the risk of insolvencies simply because you're under extreme financial distress. That was a lot of negativity. Well, but let's look at what the opportunities are for small businesses. Of course, currently we are in a very challenging macroeconomic environment, but that does not mean that there are not there aren't many opportunities for small businesses. There are, and it is perhaps going to be slightly harder to tap into those resources right now, but these are good avenues to explore to see how you can diversify your risk um, by utilizing these opportunities. Number one is digital transformation. Technology to enhance efficiency, reduce cost, and reach new markets. What does that mean? We are all aware that AI is taking the world by storm. And if anyone stands to benefit from the AI revolution, in my humble opinion, I feel it is small businesses. I'd also like to draw your attention to an excellent speech delivered by Assistant Governor of the RBA, Brad Jones, a couple of months ago, where he said small businesses in Australia are the hub of tech innovation. The share of small businesses in Australia is almost as high as 70% compared to the large businesses. So imagine if small businesses are able to invest in technological transformation, what kind of a revolution we might have in Australia. Not only that, digital transformation heavily reduces your dependability on labor. What does that mean? The labor market tightness will impact you less. It is a choice that you have to make between training your existing staff or hiring new staff. If both of them are going to cost you the same, say looking for a specialist in the market is perhaps going to cost you XX dollars, but it's the same amount that you'd have to pay to invest in training your existing staff. There's no harm in doing that, right? You already have a relationship with your existing staff. You are investing in their development and growth, and digital transformation is only going to make them more productive. To give you a simple example, if you look at ChatGPT or Copilot, for a professional services industry, these are excellent tools to put together a draft for a quick report or a quick business proposal or just simply for a client pitch. If an individual used to spend say 5 to 6 hours drafting that note initially, they are able to produce the same note in as less as 2 hours using the help of AI. It frees up 4 hours of their time. Number one, it has made them extremely efficient. Number two, their productivity has increased. Your business productivity would increase simply because now one employee of yours has 4 free hours to deliver on something else that could potentially be a new opportunity or another key priority area. Niche markets. Easier said than done. I understand businesses struggling on the ground. Um, they face it very it's tough. It's tough to find a niche market. It is tough to really completely redesign your business structure, but it is important to identify what sets you apart in the industry, and then perhaps even if not that, just simply study consumer behavior and see what they are going after. If you are servicing a certain line of goods and services and you feel that the demand for say why goods and services are much better than what I am currently supplying, is there a way I can diversify towards why, just to make sure that I'm able to keep the revenue flowing? If this is what the consumers are demanding, let me offer that to them. Focusing on specialized products and services that cater to specific consumer needs or emerging trends. Sustainability. Not only is it important to be eco-friendly in today's day and age, I think it would reduce your reliance on traditional means of utilities, which, for example, something we discussed previously was high electricity costs. If you are able to come up with some sustainable means of, of servicing your utilities needs, there is a very good chance that your overall business costs would come down. Not only that, of course, there's the benefit of having some very conscious consumers coming to your businesses, and there's a lot of support from the state or the federal government for businesses which are moving more and more into the clean green energy space. So the more sustainable your business is, the easier it would also be for you to get access to government support, which brings us to our next point, that there are a lot of available government grants, tax incentives, and subsidies aimed at supporting small businesses, particularly today. A good example would be the asset write-off extension that Treasurer Jim Chalmers announced in the federal budget earlier this year. And I'm sure there are many more, but the more you align your business to the government's priorities, the better that relationship becomes and the easier it is for you to access the grants, fundings, and any kind of incentives that the government has to offer. I'm happy to take questions now.
Fantastic. Thank you for that, Devika. If you do have any questions, please feel free to pop them into the Q&A or the chat option, and we'll be able to answer those for you while we have Devika on the line. Just give it a couple more moments to see if anybody has any that want to submit before we finish up. Okay, we can see one question's come through, Devika, if you wouldn't mind addressing around that question around property prices and what your thoughts are around that topic.
Oh, yes, of course. So property prices is a very, very interesting, a very topical question, I would say. Number one, the concern is that, again, it's economics 101. Demand has been outpacing supply, particularly in the property sector. To give you some perspective, pre-pandemic, the average gap between building approvals and building commencements was somewhere around the 3 to 4%, 3 to 4 month difference. So approvals would happen. It would take about 3 to 4 months for project commencements, and then obviously whatever was the timeline, you would see the projects getting completed. Post-pandemic, that difference has grown to an average of 12 to 18 months. Add to that, we've had a significant number of people come into Australia demanding more housing. If you look at the Maslow's hierarchy triangle, it's obviously food, clothing, and shelter. Shelter is one of the key areas. So property prices, unfortunately, are suffering from a problem of lack of labor, higher material and labor costs, and the reluctance of contractors to enter into fixed contracts, pushing up prices significantly. Now, not only that, so it's a combination of higher demand than supply for property prices, complemented by contractors not willing to go into fixed price contracts. So broadly, this problem of the property sector is unlikely to resolve itself anytime soon, because it's a structural problem. Unless and until we significantly improve the supply of housing in Australia, property prices are in all likelihood going to stay elevated. That's what I have to say about this.
Fantastic. Thank you for that. I'm not sure if you're able to actually see the Q&A as well. We've got a couple of other questions.
Yeah.
Coming through. Now, if, in the interest of time, if we don't have a chance to answer all of them, we will take them offline. And if we have your contact details from your registration, we can get in touch with you directly to answer your queries.
Yeah. I'm actually happy to respond to those questions via email as well, if that helps. Let me just see. Can I stop sharing my screen now?
We might keep it on there if you don't mind.
Okay, sure. Let's do.
So I think we've just got the last slide with the link to our, there we go. So just as we wrap up, I'll just read out one more question so you can have a think about that one. So how do you foresee the labour structural tightness changing? And what is the timing of the correction of this issue do you anticipate?
I'm sorry. Okay, how do you see the labor structure? Timing of the correction. Okay, yeah. So, okay, look, the labor market is likely to ease towards the end of the year for sure. We are already sitting at the 4.2% mark, which is quite close to the RBA's target or RBA's forecast of 4.3%. The ideal Nehru level is around the 4.3 to 4.4% mark. So now that the government has come up with policies to reduce migration, unemployment rate in all likelihood is likely to increase. This is something which is a bit technical in economics. We call it the Phillips curve, which means inflation and unemployment rate are inversely related. So when inflation goes down, unemployment rate inches up. Now, with higher interest rates, it is squeezing businesses, which means hiring intentions are going to recede, and they, in fact, have been receding quite significantly for the last 3 to 4 months. Now, as hiring intentions recede, even if there is more participation into the labor market, if businesses are not looking to hire, they are not going to hire people, which means unemployment rate inorganically, I mean, organically is actually going to start inching up. So give it another I would say 3 to 6 months. So the next 2 quarters are quite critical for the unemployment rate to rise, which means the labor market tightness is ideally going to start becoming looser and looser, and it's going to become easier for businesses to find better labor at much cheaper costs.
Okay, I think we've got time for one more that we can see. So the questions come from, I think, Gary. So just understand the RBA have relied on tracking small business insolvencies through liquidation administration numbers via ASIC. Wonder whether these numbers are now being significantly understated by the number of companies entering small business restructures, and also wonder whether SBRs are hiding the rate of small business downturn.
Oh, that's actually too tough to say right now because it's going to require a lot of the deep dive into the actual numbers and the size of the companies. So perhaps I can do some more research on this and get back to you, Gary, if that's okay.
Okay, and we might just do one last one if that's okay. Has there
Yeah.
been any impact generally on businesses from the stage 3 tax cuts?
Oh, interesting. So stage 3 tax cuts only came into play from 1st July. As of now, it is too soon to say how that has impacted consumer behavior and by extension business situations in any way. Of course, um, they have been centered around supporting households more than anything. But given how we've seen households have been struggling, I would believe the first 6 months since the implementation of the stage 3 tax cuts, most of the excess cash is going to be diverted towards essential spending and servicing their debt obligations. It's unlikely that consumer spending will spike up anytime soon. So we need at least 6 months to observe consumer behavior following the implementation of stage 3 tax cuts in July, after which we can expect some movement from essential spending to discretionary spending, which is when it will start getting reflected in business revenue growth.
Excellent. Okay, well, we might, in the interest of time, wrap it up there. Thank you for joining us today, and we hope you found this session of value. I would also like to thank Devika for her time in sharing her knowledge and experience and her expertise. So very much appreciated. Hopefully you got some great information from today's webinar. As you can see on the screen, we've just also shared the QR code, which will lead you to register for our next session in the series, which will be focused on data analytics for small businesses. We also shared the link to that in our chat earlier in the session. So if you can't access the QR code, you can access it through that method. We will also be sharing a link to this recording after the session, so using the registration details that you provided. So from there, we might wrap it up here, and we hope you enjoy the rest of your day. And thank you again for joining us.